Hi, greeting and welcome everyone. Thank you for joining us today to discuss the Intellect Design Arena financial result for the second quarter of the fiscal year 2021-22 ending 30th September 2021. The investor presentation and press release has been sent to all of you and is also available on our website. Our leadership team is present on this call to discuss the result. We have with us today Mr. Arun Jain, Chairman and Managing Director, Mr. Venkat Sarnu, CFO, Mr. Prabal Basu Roy, Advisor to the Chairman and Director on the Corporate Board, Mr. Manish Makan, CEO of IGTB, Mr. Rajesh Saxena, CEO of IGCB, Mr. Andrew England, Full-Time Director, Mr. TV Sinha, CEO of IRTM. Besides, some other senior members of Intellect management team are present in the call. Mr. Arun Jain will brief you on the results. The respective CEOs, that is Mr. Manish Makan and Rajesh Saxena, would comment on their lines of businesses. Mr. Prabal Basu Roy will summarize the commentary from the management. This would be followed by Q&A, which would be replied by the senior members of the management team. Once the Q&A starts, you can ask the question by clicking on the raise your hand, and we would unmute you so that everyone is able to listen to you. One safe harbor. I would like to remind you that anything which we say refers to our outlook for the future is a forward-looking statement, which must be read in conjunction with the risks the company faces. With this, I request Arun to give his briefing. Over to you, Arun.
Good afternoon, everybody. Thank you for joining this call. So today, I'm proud to announce the result of second quarter 2020. So I'll take five sections: Intellect as snapshot, performance overview, building on market leadership, and some of the platforms will slightly go in detail, and then some management observations. So starting it with the Intellect snapshot for the new people who are joining first time. It's a world-only next-gen composable contextual fintech platform where composability and contextuality are very important. It's ranked number 1 in global IBS, 25 plus years domain, plus 97 countries served, 8012, 30 global partners, and 260 banking clients. Now this is very interesting, the Intellect platform and product overview. The corporate banking, the GTB business of us, has got now 5 lines of business which are generating revenue for us: IGTB Cloud, Cash Power 22, Contextual Banking Experience, Payment Services Hub, Liquidity Management, and Trade Supply Finance. So on retail banking side, again there are 5 product lines: Digital Core, iCredit 360, Digital Cards, CBX Retail, and Central Banking. Then we have a similar thing on the insurance side. The business has further matured, where we are talking about underwriting, end-to-end underwriting platform, which has got 3 components. One is underwriting platform, risk analyst, magic submission, and we are digital wealth, which is going along with the insurance. RTM has got very deep treasury and ALM product, and Capital Sigma, which is asset servicing product. And there we have 3 horizontal platforms, which is iGovernment, which is GEM, iTurmeric, and IDX. IDX is my AI platform, and iTurmeric is my digital accelerator platform. In this quarter, we proud to say that we achieved 450 crore or 452 million, $4,521 million in this rupees in this quarter. I think this is a major milestone for us. It is 3 times our revenue when we demerged the company from 1,500 million at that point of time, 150 crore company at that time. We were looking between 13 to 19% growth. At the high teens, we are able to achieve 22% growth consecutively in the second quarter, which is again a major milestone over here. Other biggest milestone is our SaaS and subscription revenue, which is jumping 156% in this quarter. License is coming down, covered by the SaaS revenue. AMC is growing at a 9% level. Other metrics are gross margin is improving to 26% from 24% last quarter. Quarter on quarter it's improving. And gross margin is improving from 56% to 58%. So it's inching towards 60% gross margin. That's what we are targeting for quite some time. So it's now 2% short of 60%. Investment in the product is $290 million. PAT has grown 34%. And another important milestone this quarter we achieved is it's the first fintech company with so many product suite with a zero debt and a cash balance of 257 crore is a significant landmark in looking at it. There's a half-year performance. If you look at it, is same as 22% complete on $116 million, 860 crore of revenue with a EBITDA of 218 crore, license of 166 crore. SaaS and license now are matching number, 165 crore and 166 crore, and AMC is also 160 crore. So all the three engines of recurring of the license link revenue are now coming to the point of over 640 crore or 650 crore. Each engine is annualized basis driving the engine. So which is quite heartening to note that, not 640, 166 crore is half year number. So I just multiplied, but it should be two times the number. It's around 320 crore. Each of three engine is providing 320 crore annualized revenue number, which is quite good from a license link revenue. And recurring revenue is also license AMC plus SaaS, which is itself is close to 320 crore, 325 crore. Over here, for the half year period, the PAT has grown to 50%. I just want to highlight over here the Q2 we have a very good EBITDA margin of 118 crore, but a PBT of 90 crore because of the shift of 11 crore between positive FX revaluation to negative 5.75 crore of the revaluation. It is purely a virtual entry in the books of accounts, so it doesn't make any impact on a half year basis. The PAT has grown 50% in half year period. So that's the number which is important for first half year, is 50%, because half year presents a better picture than a quarter presents a better picture. We have a healthy pipeline of $649 million, close to 5,000 crore worth of pipeline is sitting with 54 destiny deals which is available. So this is another good traction which is happening. It's growing from $540 million last year to $628 million previous quarter and $649 million this quarter. Deal size, deal values are increasing. This is the nature of the slide, that how many deals or the destiny deals we won in the quarter. These are summary numbers which you might have seen. This is another announcement we discussed in the board, and we looking for investing now. Platform got stabilized. So just to summarize, our platform got stabilized. We crossed $60 million quarterly number. So last quarter when I was speaking to you, I was talking to you about $60 million is a benchmark from $45 million per quarter to $60 million per quarter. So last year quarter one was $45 million. We prepared ourselves for $60 million. And we are saying that we'll jump to $75 million. So it's a stabilization of $60 million is a first landmark. We did $61 million this quarter. So, and now we are ready for $75 million capacity. Some of the capacity cost increase in this quarter is to prepare the capacity for $75 million a quarter for next 3 to 4 quarters. So it took 5 quarters for us to reach from 45 to $60 million. We like to shorten the cycle for the next growth of $60 to $75 million per quarter. And we are looking to create a AIF Cat 3 fund for investing into the companies where we can use Intellect technology stack, which is quite substantial, to leverage and go to market using those companies in fintech space. So that is a board approval right now. It will take some time for this to get approved by SEBI, and then our investment will start happening. So today, this is a kind of a deal wins. In 9 new deal wins, including 6 platform deals. So important point today is platform deals. We have 4 platforms now. GEM is the first platform, which is growing 100% year on year compared to last year. GEM platform has, in first half year, close to 40,000 crores sale happen on GEM platform. It's growing very healthily. Second platform is Cash Power 22, which is launched by GTB, which is completely microservices platform on Azure. Then iCredit 360, which is the third platform, which is complete end-to-end open finance platform, microservices led again, to be launched in Germany. And for the Europe customers, this is a platform which is open finance platform. And fourth platform is my underwriting platform, which is end-to-end from document extraction from the mail to driving a data enrichment, and then to a complete underwriting platform, which is launched 1.5 years back. Now we have signed one more deal in that platform. So this 6 platform deals are very, very critical, because this is going to drive, and this is what I talked to you about in Technology Day. When I was talking about the various kind of technologies what we have that time, those technology was nascent in nature, but these technologies are now mature, and we start winning 6 deals. So we announced only 2 platforms in this quarter only, and this deal wins are a proof that this platform has a good attractiveness in the marketplace. We are getting a consecutive deals in every quarter in Europe. Europe has a great potential because a lot of legacy sitting there, and they can catapult their technologies by open usage of open microservices and open platform. So today, what we are looking at it, that we can take you to this platform, that how different these 2 platforms are there, where Manish and Rajesh will take up to both the new platforms which is there, so that you understand how different they are and what space they are competing. So this is completely competing in the space of modern fintech in Europe and Americas, like Encino or Thought Machines equivalent platform. But in corporate banking, it's a very, very unique platform in cash management in the world space. And that's where our bullishness going forward, that we can grow over 20% for this year, as well as we feel that this can accelerate our journey of growth in coming quarters still better than that. So our 54 deals, destined deals with us are very, very exciting for us. Besides this, 26 go lives in this quarter is quite a record, where 10 out of which 10 are new digital transformations, and 16 are digital transformation with upgrades or expansions. Now at this point in time, I would like to give it to the IGTB Cash Cloud, Cash Power 22 to Manish. Manish, if you take it from here and tell me to press the buttons.
Sure. Thanks, Arun. So this is a brand new platform, IGTB Cloud Cash Power 22. This is built on our current footprint of serving 55 customers across 37 geographies across the world. And this is about creating that experience and creating the availability of a software on a managed services basis. So the CIOs don't have to worry about what is the CapEx as an opportunity, integration technology as an opportunity, and how will the operations experience be run. Arun, we can skip to the next one. This is the first platform in the world which is truly answering the challenges each of the CIOs are being challenged by the fast-moving tech world as well as the demands of the growth of the transaction business. So we've taken away the challenge of where do I find capex from by converting this in a subscription basis. Instead of a rip and replace, banks can actually look at starting new business straight on this and then migrate the platform from it. And the CIO doesn't have to worry about running his own data centers. It is straight away bring new business in, get started, and then migrate the business. And you pay as you grow. That's a very significant advantage from the customer's perspective that this will take away the challenges of moving to a new platform. And from our perspective, this is a great growth journey. We truly grow along with the banks as they grow. This is the SaaS business we've been looking at. Our next one, we've configured this product into serving. Our next slide, please. Yeah. Serving all the needs of cash management from a business banking, SME, and large corporates. We've created 3 packages from a cash now to a cash extra to a cash power. These comes with ready user journeys and comes with ready APIs, and they have market integration frameworks already pre-integrated. This gives a significant advantage of time to market for any new business manager to be able to go out to market and realize the benefits reasonably fast. These are market ready, already proven into 55 customer bases across multiple geographies. Our next one, we're able to now roll this thing out between 10 to 25 weeks using our iZoom methodology. This comes with 130 plus ready interfaces, and it comes with a test pack of more than 6,000 test cases. Banks can actually pick this software in, configure their business use cases, validate their integration with test packs, automated test packs, and get going. So they're true business accelerators, integration accelerators, and IP technology accelerators. So take the challenge out of what CIO was facing and give to the business manager the time to market really after conceptualizing where they want to go. In today's world, the business managers had to wait for 12 to 18 to 24 months. So converting the months into weeks is a challenge we had taken, and this is what we are right now driving in. Going to the next slide, you've got for all market competitive products on the co-bank side, ready robust Intellect integration layer built in, and this is already live with all of these environments from that perspective. So if you picked up any of the core, be it Intellect, be it Finestra, be it Infosys, Flex or Temenos, it comes prefabricated for you to get onto it. API integration has been a big challenge for most CIOs and they burn a lot of money. Consuming cash power has been made very easy with ready turmeric interfaces which have been built in. Our next one, along with Microsoft Azure, we built up the IGTB cloud, which is now going and covering close to 70 countries. If you would look at, we've already announced this on 16th August for available in Middle East and Africa. Over the next quarter, we are announcing APAC, Europe, and in the subsequent quarter, we are announcing Americas from a go live. We started configuring the data centers with these instances. The asset is ready, and over the next 2 quarters, we will roll out to the next 70 countries. It significantly improves the TAM available for us to cover across these 70 markets. If you will look at in 70 countries, there would be at least 8 to 10 banks, leave aside the large countries. So it multiplies the available market space significantly for us to go and cover. So I believe we have a space to go after 1,000 banks on commercial banking for business banking, SME or large corporate with this announcement. So this unleashes truly our capacity, and whatever investments we've made till now, it's about monetizing and scaling that up. I'll hand it over to Rajesh to talk about iCredit platform.
Thank you, Manish, and good afternoon and good evening to all of you. It's a pleasure to speak to you again today. Today, I'm going to talk about iCredit 360, a custom-built platform that we made for Europe and launched in July of this year, and our Open Finance IDC platform, how they are helping Resource Bank to be a market leader in sales finance. Arun, next slide, please. So to just set this in, from a context perspective, Resource Bank is a Nordic bank headquartered in Helsingborg, Sweden. Helsingborg is a small town, beautiful town at the southern part of Sweden, and this bank has had a legacy of growth and expansion over the last 40 years that it has been in business. It is by far a leader in consumer finance business in Nordic region. Not only is it a leader in consumer finance, it's a leading partner for sales-driven payment and loyalty solutions, both in retail, physical retail segment as well as e-commerce segments, has best-in-class in-store credit. If I may just want to compare them with Bajaj Finserv from an India perspective, something similar to the model that Bajaj Finserv have in India, and it prides itself into having a very agile business model. If we can go to the next slide, please. So when Resource Bank started in this journey, they looked at what were their various pain points, and their pain points was, and I think Arun talked about it, is they were sitting on legacy, and as they were sitting on legacy, a cost of development was very high. They were having manual processes. The other thing which Nordic region is seeing now is a very dynamic change in the payment landscape. And any change in payment landscape, the bank was having difficulty in coping with those changes because of the limited flexibility that their legacy system had, and of course the operational risk. So they looked at this agenda and they said they wanted to move into a digital transformation, and the digital transformation goals that they set up were establishing a foundation for a 24/7 bank, becoming a self-service bank with very fast time to market, and very important to them, since they are in the sales finance business, enhance customer and partner insights. It's very interesting to see how we got into this deal. So Resource Bank, when they started in this journey, they actually approached Gartner, the analyst, and talked about their digital transformation goals. And Gartner actually suggested to them that if these are your goals, why don't you look at Intellect as one of the partners for choice? And we went, and that's how we got into this deal. We went through a very rigorous 18-month sales cycle. We had more than 30 plus workshops, 3 months of very detailed proof of concepts. Remember, we are relatively unknown in Nordic region, and what started as a long list of 21 vendors at the start of the 18 months, we finally won this deal against Temenos, Mambu, and Thought Machine. Not only is this deal important to us, it's also very important to Resource, and this can be seen by the way they advertise or they marketed this deal in the Nordic region. They had a press release, they had a capital market day, and with many of their senior team members talking about this deal and why this deal is so important to Resource Bank. And they talked about this, and I want to highlight to you, these are some of the snippets that we have picked up, but I want to highlight the last line on this, where they're talking about this deal as Resource Bank invests in the Nordics region's first cloud-based banking platform. So they're calling this as the first cloud-based banking platform in the Nordic region. If we can go to the next slide. What are we delivering to them? So what we deliver to them is actually an open finance headless platform. Let me spend a couple of minutes talking through this. So if you look at the top layer, the mobile and the internet channels, this is going to be developed and managed by Resource Bank. They also, as I mentioned earlier, they are in the sales finance business. So they have partner ERP systems and e-commerce marketplace, all managed by the retail chains. All of this is going to talk to our open finance platform through 300 plus compliant open APIs. And if you look at this shaded box, this is really a platform, what we're calling as the Open Finance IDC iCredit 360 platform. If you see the first horizontal layer, this is the turmeric layer, which is providing us the extension SDK, the API management tool and process orchestration layer. The second layer that we're developing for them is the customer 360. This is the assisted customer 360 channel. We're going to give them origination, which is on lending, cards, and sales finance, as well as partner system and integrated invoice processing. From a product processor perspective, we are going to give them core, lending, and cards. And this is important for us because this is the first time we will be giving a client a platform which cuts across core, lending, and cards. We've done deals which are earlier with core and lending, but this is the first time we are doing with core, lending, and cards. And this puts us in a unique position because none of my competitors have the cards capability. We are also going to be using marketplace for payments and document management. We are tying up with two marketplace players to give us that capability in the Nordics region. We also will be integrating with other resource systems like Swift, Gateway, Card Switch, and other 20 plus systems. All this is done through 300 APIs, 100 plus PVCs, microservices architecture, and real-time event-driven architecture. If you can go to the next slide, please. This is the first cloud-based Nordic banking system, which is completely container-based, microservices-driven. Interestingly, this is going to be hosted in AWS Germany, managed completely by us, which has auto-scaling and demand spurts. It is multi-entity, multi-country, multi-time zones, multi-branches, multilingual, as well as multi-currencies. It's a very flexible system. We can go to the next slide, please. Innovation and agility is a key ask for research from the technology partner, and we are going to be working with Resource Bank to provide innovation as a service. What this means to us is quick response time, accelerated release process, conceptualizing and creating, test and launching partner products on the fly. Very critical requirement for Resource, and in a rapid mode from code commit to build using CI/CD models. So as I talked about this, that Resource being a the majority of their business being a sales finance business, they have key relationships both with physical stores as well as e-commerce market players. And on the right-hand side of the slide, you can see some of the big chains that they have tie-ups with, big and important chains in Nordic region, which are important to them, like Bohas, Miles and More, etc. So we are going to help them to be hyper-connected with their marketplace ecosystem, which involves quick onboarding for developers and partners. Our API-first architecture will enable them to embrace and extend this relationship to their partners. Event-driven architecture, as well as partners can go from concept to test to launch within days, and that's how we want to help Resource play in this market space. Next slide, please. So this slide actually talks about, I think I mentioned this, about 100 PBCs. So let me talk a little bit about PBCs. I don't know if all of you are aware, but what a PBC is typically either a single microservice or a combination of certain microservices which can deliver a complete business function. A PBC can be independently deployed, it can be version controlled, and most importantly, can be independently sold as a function to a player. So here, if you see this chart, we have over 100 plus PBCs, and if you can just go through some of this, for example, in deposit, we have a PBC called deposit operations. That means this is a complete operations function PBC that we have. It's completely isolated, can be deployed, and can be sold separately. So you can see how we have composed our businesses through this PBC. We have PBCs in deposits, we have PBCs in payments, account operations, customer management, lending, marketplace, enterprise services, as well as iTurmeric. We go to the next slide. And this is what we have from an Intellect public open APIs. We have today more than 300 open APIs, Intellect open APIs. These are published on our portal, and this is what we are using from our open finance platform. Not only do we have our 300 own APIs, we also have 90 plus partner APIs. So all these APIs are helping us in building the system. So you'll see this again, this APIs cut across deposits, our card systems, lending, payments, accounts, enterprise services, as well as partner API. So I thought I'll just today give you a little bit of glimpse of what is under the hood of our open finance platform and how it is helping us to win deals in Europe. That's what I had. Thank you so much for giving me the time today. And I think I'll hand it over to Prabal now for a quick summary.
Thanks, Rajesh. Thank you so much. So I will just take maybe a couple of minutes, to essentially for the investors, old as well as new, in contextualizing and summarizing, where we are on the journey of building Intellect. I said Intellect 1, as you know, the older investors know, FY15 to 18 was all about making large investments of almost 3,000 crores in sales and marketing and technology and R&D, building the brand of Intellect in the heart of advanced markets in London, building an MNC team with domain experts, and of course, most importantly, figuring out that niche product strategy of liquidity, which was a gap in the international markets. So this is what we did in the first. Of course, this meant severe strain on the balance sheet, cash flows, and it was funded essentially by rights and promoter funding. So that was Intellect 1. Intellect 2, FY18 to 21, was about industrialization of processes, design thinking, making investments ahead of the curve in cloud technology, data, AI, ML related technologies, and the beginning really of the monetization phase, which is what saw positive cash flows, profitability, and so on and so forth. Intellect 3, which is where we are now, and that would be of keen interest to most of you, is this period of FY22 to 25. Now, as you heard Arun, Manish, and Rajesh sort of speak about, this is the phase in which it will be all about transitioning Intellect from being a stable product company to an open fintech platform. And this is, investors, you will understand this is a non-trivial transformation and something which we have alluded to in many of our previous calls, and especially when I was telling you about the potential which an IP-led company like Intellect has, in where we essentially control the IP of the products, and thus have the inbuilt, flexibility of leveraging the IP for creating new business models, product offerings, and essentially using all our inbuilt levers to create significant non-linear value creation over a period of time. You would recollect these statements which we had made consistently over the last 1 year or so. So now is the time where, as you heard, that we'll be migrating to a platform, an open platform, fintech platform, which is very, very exciting. So in the context of the financials which Arun took you through, I think at a high level, I would say we are continuing on our guided strategic path, which is calibrated growth with predictable profitability. So you have seen for the half year, 22% revenue growth in dollar terms, 39% EBITDA, 50% profit after tax. So all the effects of operating leverage of a standard model are coming in place. More hearteningly, is the fact that the quality of revenue has improved significantly, with the SaaS revenue going up to 127%, etc. in this period, and is now almost 20% of the revenue pie. So that is on the regular business. So I would suggest, I also forgot. In terms of cash balances, I think we probably are the only product company which is investing into platforms, investing into products, and yet is a totally debt-free company today. is a very far cry from 2 years ago when we used to meet all of you, right? So that's also an extremely. So I would think net on a high level basis for investors, especially for investors who are willing to look at us, I would say that we are in the phase of where we are about to take the benefit of our inbuilt ability of leveraging our IP to open up new vistas of growth and non-linear value creation, while we continue on a strategic, guided path, which is calibrated growth with predictable profitability and keeping a keen focus on the balance sheet. So you can see it's a very well-rounded financial strategy, which embeds with the technology strategy of the organization, and therefore, all the trust which you have given us over the past many years. I would hope this is the time now to actually reap those benefits. Thank you.
Thank you, Prabal. I really appreciate the 3 presentations. And the delight is that it's a debt-free company, fintech platform, where you're looking for a single product to be single platform cost almost $300-400 million to platform. As of now, 4 platforms, plus there are 2 more platforms in the making. So around 6 platforms. In the last 7 months, when we expose the technology day, we just open the bonnet to say what technologies we have. So it's not just a product what we have, asset we have. The beautiful team at Intellect, the talented research team, I'm take pride in my research team, the way they work together across the business line, across the horizontal technologies. I think that's my dream, that we can create a Silicon Valley level teams of research and development out of India. These are the outcome of last 7 months. Is quite surprising. Even winning the deal in Europe against Thought Machine, where their investments would be hundreds of millions of dollars, and to compete in those deals or Cash Power. Cash Power is like a completely new platform for 1,000 banks. Suddenly the TAM has gone from 300 banks to 1,000 banks. It's a interesting way how technology can drive the change for the marketplace to adopt a new technology. So with this, let me open it for question answers. So you can type the question in chat box, or you have a raise hands. Both the things are available. So please do both of it.
Thank you, Arun. The forum is open for Q&A. In case you want to ask a question, please click on the raise your hand. I repeat, please click on the raise your hand. We'll unmute you, and we'll be able to listen to you. Please raise your hand. Mr. Jagdish. Mr. Jagdish, please ask a question.
Yeah. Hello, able to hear me?
Yes, Jagdish.
Yeah. Congratulations for a good set of numbers, and I'm proudly owning this stock for a few years. So my question is, right, so we have recently announced an alliance with one particular partner, right? So I just forgot the name. So in future, what these alliances and partnerships, right? So are we going to do many alliances, partnership, and driving the growth in this way? So could you please throw some light on this?
Manish, you would like to?
Yeah, this was with Corelius for artificial intelligence for trade finance. I think it's about building a marketplace where we can consume a lot of fintechs as we offer our offerings to the customer. We don't necessarily need to build 100% everything. There's ready available APIs, there's ready available assets. Our goal is to be able to serve our customers and give them offerings, and where big focus is to become that fintech, cloud native, leverage data, AI, and be able to expand their offerings.
Okay. Yeah, recently one of the Indian MNC, right, it a partnership with the Finestra for this to drive the growth, right? So are we dealing with any GSA, global system integrators, to implement our product, or maybe we are focusing on platform, right? So maybe do you think is the time to add on these partners, maybe GSI, like our Indian MNC or global MNCs?
Yeah, Jagdish, we're working on the same thing also. So go deep into large accounts is where we're going to try and do ourselves as well, along with these large system integrators. And go wide is where platform will help us do it. Rajesh, you wanted to add something, I think, right?
No, I just wanted to say that we have a strategy wherein we have decided what is core for us and what are the things that we will tie up with the marketplace partners. So from an IDC marketplace perspective, we already have 30 partners who are giving complementary services. So when a client comes to us, he has not only services from Intellect, but he can also take up partner services. So that's the complete story, ecosystem story that I wanted to talk about.
Yeah, and since now our platforms are headless and composable, that's where banks can co-create along with themselves or along with the large system integrators. So we're working with some of them right now in a couple of bits.
Okay, great. And two platforms are in pipeline, right? So I just maybe as a layman, from product to platform, right? So what is the changes as for the bank, right, who are using our services? So if you are providing one product or platform, right? So in simple terms, what is the change they are having? Maybe could you have explained greatly, but still for the layman terms, could you please explain that part also?
Jagdish, simply at a platform, you're part of a network where you consume services, or you can be consumed to offer an offering to a third end customer from that perspective. Because of the architecture of microservices and API, we can consume anything and as a network, become a network and offer that extended to the customer base.
Okay.
So
Yeah, that's great.
For bank to onboard, so it gives you a subscription-based revenue. So we can charge a bank $50,000 a month to $200,000 a month for our services. For us, we don't have to install the software at that side product. We need to go to bank. It takes 12 months to 18 months to implement the solution. In a platform, it takes 3 months to 6 months to implement the platform. So platform is an accelerated way of driving the change, and it gives you the SIs, what we are talking about, global SI, ability to co-create or compose the solutions on it. So now we have a head of partnership, Kannan Ramaswamy, and he's building partnership with Indian multinational, what you're referring to.
Okay. Yeah, thank you. I'll come back to the queue. Thank you for answering those.
Thanks, Jagdish. Next, we have Mr. Mohit Jain from Anand Rathi Securities. Mohit, can you ask your question? Please unmute him.
I have 3 questions. One is related to this investment. If you could help us understand where is this 100 crore investment suddenly came into play, and how much would be the cash outflow with respect to this, and for what reason? And second was related to Prabal. Sir, actually, he was talking about quality of revenues in the opening remark, but it appears that our working capital has not resulted into cash flow generation in the first half, in the last 6 months. So how do we exactly measure, and what is his expectation from a cash flow perspective for second half or for FY22? And third was that you or I could not find the regional breakup. Earlier you used to disclose what is happening in advanced markets versus India versus emerging. But this time I think this number I could not find. So if you could help me derive the numbers in the old format, advanced markets and others, that will be great.
Okay, so first, Mohit, your question is about AIF. What is the purpose of AIF? When we are now building a platform and a marketplace, in this marketplace, we have a core platform, whether it's a core banking platform, lending platform, cash management platform. We are experiencing the opportunity to invest in some of the companies which can consume these platforms and go to take to the market. Now this could be, we can acquire the company, or we partner the company, or we take a minor stake, not a majority stake, but minor stake in this company to leverage this platform. So that's a AIF application we'll be applying. It will take another 6 months to get the application through. And then we can work towards the partners which Rajesh is mentioning, we have 30 partner in for IDC marketplace. All these marketplaces have access to their customers. Some of them are B2C, some of them are B2B partners are also there. So there we can leverage our platform to be more efficient manner is the purpose of AIF. About second question, you're asking about cash flow generation during the
first half.
First half, yeah. So cash flow generation in the first half is some of the GEM payments are stuck right now. So that is creating some of the stress for the cash flow generation compared to the what we expected to do it. So we are now looking at in this quarter we should get some significant chunk from government. So that's one possibility. So exact number we will not be able to project for this quarter or next quarter, but I think cash flow positive is there. As of now, EBITDA is 118 crores. So that's more important is from 100 crore to 118 crore, 18% jump in EBITDA is a major jump in this quarter. And with the third question?
Just a follow-up. Also, advanced market DSO has also gone up for some reason.
It's a 2 days here between 122 to 122 days. So it's not advanced market. It's a global market. It's a 122 days and Indian market is 214 days. So it's a advanced. It's not a advanced market DSO. Advanced market DSOs are less than 90 days.
Right. The third one was related to advanced market regional breakup of revenues, which you used to give till last quarter.
Okay, we missed it on this quarter. Nacho, just note it down. We just send it, or you can type on chat box.
Sir, one follow-up on this investment, the nature of investment that you spoke about in response to the first question. So you will be investing in those companies which will sort of implement Intellect for clients. Is that what this AIF is all about?
Not necessarily. I think the marketplace concept is evolving, Mohit. The marketplace concept has a element where you want to go to next to the customer. You have some potential to offer partial service to the customer using Intellect assets. So there are many opportunities are there in open marketplace where these opportunities are, we are experiencing it. And it could be an investment of 5% to 30%, anything could be possible based on these companies. So this is the ecosystem development AIF. So the next stage from product to platform is to ecosystem. So all the big, whether Salesforce.com, if you look at it, they acquired Mule. So they invested in Encino, they invested in MuleSoft. These are the typical ecosystem player companies where they invest in early stage and help the MuleSoft to come up and become a core player with them, or they become an Encino. They invested in early stage. So these are the new model on ecosystem development. It's a very small money we have committed right now, 100 crore, not a big money committed. We can.
So from a cash flow point of view, 100 crore will go out in FY22. Will it go out in 23? How will it?
It will not go out in FY22. By the time it will get approved here, the CB itself, it will take a lot of time here.
Okay. So we should not take this impact in immediate financials, right?
That's right.
So Mohit, I mean, let me just add a couple of points to what Arun mentioned for your benefit. The way we are looking at it, and hopefully you can also sort of empathize with it, is this is the financial wing for the enabling system, for enabling the ecosystem he is talking about. So this is the part which will give us the financial leverage to do that. It was not necessary. At the same time, it can be a great force multiplier as we go along. For example, I mean, you have a clear case, for example, of business models in India. Internationally, you have many like Cisco, etc. But in India, you have what Zomato did, for example. InfoEdge had investment in Zomato, which was an adjacency, in some form. In our case, it will be much more closely linked because it will help us in financially leveraging, partners who are willing to join the ecosystem. So look at it like that.
Okay. Next.
Thank you, sir.
Thank you, Mohit.
Thank you, Mohit. Next we have Mr. Vivek Charoria. Please unmute him. Vivek ji, please ask
Hi,
your
sir.
question.
Thank you for the chance. So, in our journey from 60 to $75 million, how much of the cost impact is already factored in, and how much, and do you expect the full impact to come in by the next quarter or two, and then the operating leverage kicks in? I just want to understand, how do you expect the cost increase to show up in the numbers, and by when?
Yeah, so Vivek, if you look at the numbers, we looked at it EBITDA to be 30% EBITDA. That's how we forecasted the company from last 1 year, that we'll be moving from 20% to 30% on EBITDA line. We reached to close to 26%, including ESOP cost. If you take ESOP cost out, it's 28.5%. But let's take 26% number. So this $75 million, we are quite confident that cost will be increasing on quarter. So everything cannot be taken into account, because the deals which have come up in last quarter needs to be provided a new headcount for closing the delivery portion of the deal. We are investing into sales systems in countries like Cash Power, which is available in, it can be available to the world. Those investments will be there. And I think instead of working an actual number, I think we are guided towards 30% EBITDA margin. And that's what our direction is there in next, whether it takes 2 quarters, it takes 4 quarters. That's the number we are looking at, 30% EBITDA margin of taking all the cost inclusive.
So just, and you mentioned that you want to shorten the time period from which you want to go from 60 to 75. I mean, is there a ballpark? I mean, should we expect that in the next 5-6 quarters, or much before that, like maybe 4 to 5?
Definitely, we want to look at it. If it took 5 quarters, so 45 to 60, then we should take 4 quarters. So whenever as management team we take a goal to ourselves, we need to reduce by 1 quarter to reach to $75 million. So, but we don't making a promise of this nature, but that's what we are having, again, directional view on this particular thing, the way we are seeing the market and the pipeline, what we are seeing, that it could be achieved in 4 quarters.
So just one slightly longer term question. In the last call that you mentioned that, I mean, as a company, we intend to double our top line in the next 4 to 5 years. So should we take this 20% top line growth as a one-off, or do you expect that maybe our potential growth rates has jumped from, let's say, a 14 to 15 to more like an 18-19%? I mean, are we more confident on hitting those numbers maybe a year before? Slightly a longer term target.
We are confident around 20% plus now. So we were cautious about when we announced in July, we were cautious about it, whether we'll get it to 20%, or that's why we are saying mid-teens as a number. Now we are confident of 20% plus for at least next 3 quarters. We are confident about 20% to be maintained. Beyond that, we can't look at it as of now.
Okay. Thank you so much.
Thanks, Vivek. Thanks, Vivek. We next have Mr. Ankush Agarwal. Please unmute him, Mr. Ankush.
Yeah. Hi, am I audible? Hello, am I audible?
Yes, Ankush, please ask your question.
Hello. Yeah, so a broad question on the possibility of long-term operating leverage that can play out in our company and our business as a whole. So if I look at one of your peers, Temenos, over the last decade, they have been able to improve their margins year after year for nearly a decade now. And they have been guiding that they will be able to continue to do so over the next 5 years as well. Right? If I look at Intellect, we have seen operating leverage play out sharply for the last 6-7 years, primarily from the time COVID started. Right? Not very sure how much of that was due to cost savings on account of COVID. But if I see now, the costs have started inching back higher. Right? We are already back to pre-COVID levels costs. Right? The cost have jumped 18% this quarter. So wanted your thoughts on how do you think about this operating leverage sustaining, and do you think that we can build on this operating leverage year after year like what Temenos has been able to do so?
Ankush, in a product and platform company, operating leverage is a very natural part of it. So it's not something we need to do every year. My all recurring revenues which are there, they come at a cost structure of much higher margin levels. So cost leverage is available year on year. So 118 crore EBITDA and the 2% increase in EBITDA margin, which includes the talent cost which has gone up in last quarter, where every Indian IT company has decreased in their EBITDA margin. We have increased that 2% EBITDA margin. So this is a operating leverage which is visible right now. I'm saying 30% we are looking right now. And we want to reinvest more than 30% into building the business and accelerating the business growth from 20% and higher. And that's what our agenda would be, and to look at the cost leverage. So my suggestion to the investor is it's not about cost leverage, it's about the market share. The opportunity size is very, very big. The market size of Europe, what Rajesh has mentioned on open API platform validation from the customer who has 21 vendors and being selected as one of the last vendor out of 21 vendor on open API platform is a very, very big story. This is like against Thought Machine who has invested millions and millions of dollars against that. We are bidding with a very low shoestring budget to get into the new country is something amazing area. So the cost increase of 10 crore, 20 crore, 30 crore quarter on quarter, I think that is should not be a concern. I think question should be how do we get a legacy opportunity market and lead this business from 20% to 30% levels, and that's what our questions in our boardroom is. Can we increase this 20% growth numbers to 30% growth numbers? That is our question, which you are saying 22, 23, 23, 24. Those are the questions we are asking. As soon as this growth numbers increase, margins are natural part of the outcome.
Right. So would it be right understanding that now as we are trying to move from product to a platform company, we are fine with even having the same margin, but we want to grow more on the top line, get market share or grow Intellect as a business size?
We could hear the full question, Ankush. It was a breakdown on.
Right. So what I was saying is, so would it be a right understanding that now we as a company are not much focused on getting the operating leverage juiced out, but more on growing our top line by moving from product to a platform company? Would that be a right understanding?
Ankush, 30% margin is a very good margin here. We are not we are not compromising the margin. 30% margin, EBITDA margin is a great margin in a global company for investor. And then we are looking PAT growth of a 50% in a 6-month period, and even if 30% PAT growth is a very good growth for any investor.
Ankush, let me try and address what I think I'm hearing you say. See, as I mentioned in our financial strategy overview, we are moving to this platform phase, building the ecosystem, all of that, but not by compromising these steady cash flows as well as the steady financials which we have built up over the last couple of years. So while the EBITDA will continue to grow from 20 to 30% in that range, it will continue to grow. We'll continue to sell products. It is the allocation of that cost, or allocation of the excess cash flows which are getting generated, some part of which will go into building this ecosystem of platforms, so that the future will be far more exciting in terms of creating a non-linear expansion of profitability. Unlike, let's say, OFSS, a company which all of us know well, right? iFlex.
Right.
They are not expanding, but their profitability is still very high because of the AMC revenue streams.
Right.
At a percentage, right? Now, what would you rather have? Would you rather have a company of this nature which does not expand but basically rests on its laurels of the past, which is perfectly legitimate as a strategy, or would you have something which continues to build a products pipeline, continues to populate the marketplace with its products, and then move on to a platform with its own money, with no capital dilution, mind you. There is no capital dilution at all in the scheme of things. So the capital allocation will be tightly controlled, and that's what I mentioned to you. While keeping a keen focus on the balance sheet, we will be doing all of this. So it's a tricky game. It's a very tricky game. But I mean, investors like many of you who have been with us in the past, we have been saying this from FY18 onwards, and we have delivered on each and every parameter. So the issue is to have trust that this is the path we have designed for ourselves, and which will be ultimately creating hopefully immense value for all shareholders.
Right. So secondly, on this capital allocation, so the first part you have been clear that you want to invest in businesses to expand or to accelerate your journey to a platform. But Sajjan, what are your thoughts on using excess cash for buybacks? I mean, you have been very vocal about the fact that Intellect or say software products business are not properly valued in the Indian market. So don't you think it would be right to use some of the cash to buy back at current levels? I mean, it would be akin to reinvesting in Intellect itself at the valuation that we have currently.
Ankush, this is a too early a game here. This is, I think we are strategically building a company, not getting into this financial game, and not on the cost side, not on the. We are a technology company, run like a technology company. We are just saying we are zero debt fintech platform in the world, which nobody has. So I think that's the message I want to leave it to you, rather than getting into the financial maneuvering of the company.
Right. So just the last one, I mean, on this open architecture platform that you're talking about, so can you list down some of the use cases? Like, for example, if you, what my understanding is that Salesforce is the open architecture platform which has done very well on the CRM side, right? But on the banking side, what are the use cases that some of the use cases that you can list when our platforms could add value to a large number of companies for business models?
There are many of them. We can have a technology day too. I think we are planning sometime in last week of November and December, some technology day where we can explain you those use cases.
Okay, fine. That was very helpful.
Thank you, Ankush. Then next we have Mr. Rajiv Agrawal. Please unmute Mr. Rajiv Agrawal. Mr. Rajiv Agrawal?
Yes. Thanks for the opportunity. I have been a shareholder for a very long time, and it's great to see the confidence that the management is displaying now and the results. So that's wonderful. Now the company seems to be moving from the products to the platform. Now, this transition, can you talk about how, you explained in the Cash 22 how the TAM has gone from 300 banks to 1,000 banks. But what is the broader vision that you see of the company in terms of what are the possibilities, let's say 5 years out? I want to understand, because this seems like a step change in terms of how the company is looking at itself, right? Earlier, we always used to talk about the product, and now we are saying we are an open API platform, and therefore we can easily be embedded in many of the use cases of different financial institutions. So I would just want to understand from your perspective, what is it that you are thinking of, let's say 5 years out?
I think 5 years out is an amazing potential which is there. If you look at it, the amount of spending is a long conversation which I am passionate about. You hit upon that service company, when they are growing 15, 16, 20%, how much is the value addition and business impact they are making to the customer, or they are doing the same job in a workshop format? It's a garage business who are keep repairing some digital solution on the top of their legacy platform. You can't change a legacy house by making a Asian paint on the top of it. Asian paint can be there on any house, which is 20 or 100-year-old house. Still, it will have a leakages there. We are saying it's an open API platform where the cost of a technology per account, which is close to $100 per year for a European bank to build this technology. Research is showing why the research is so exciting, because they feel that the cost per account will come down by 1/10, because they don't have to spend in hardware, they don't have to spend in middleware, they don't have to spend in networks, it's all on cloud, and they are getting a composability which is available to them. Now this model can be taken up if 5 years hence, it can be taken up like a SAP journey, where multiple SIs start consuming my APIs, because you asked the question 5 years from now. They can consume, bank can consume my API directly. So they will pay me the subscription of, let's say, $2 million a year, $1 million a year, $3 million a year. That's a big number. If I get $1 million subscription a year, $2 million subscription a year, if I have to build up this platform on a cloud for $100 million business, even in going next 2 years, it's not a rocket science to get 50 customers on this open API platform with the ability of what Rajesh mentioned. We have a core banking, lending and cards on a same APIs. No single player in the world has got this 3 platform where I can book a loan can be booked in loan book, or loan can be booked into unsecured credit card book. Is a ability to design those services and products. Or for cash management, I can have a collection, and having a bills discounting coming onto the same platform. I think there's a huge composability there. Our excitement is humongous going forward, but we want to be ensuring that we are calibrated so we don't make any error in this journey, because the market size is a $100 billion market size. Right. We need to replace services business out of this from this our business.
Right. It seems to me that, with this transition from a product to a platform, you will have a lot of incremental improvements both in your revenue, profitability, and so on. And it will become a lot more consistent versus in the past where you used to depend on a few big deals and therefore it was a lot choppy sort of results, let's say. But now with the platform thing that you're talking about, there seems to be, because it's a smaller and much wider market that you're looking at, suddenly you will have a lot more consistency and gradual improvement in your numbers. And sort of the J curve that we always talk about in the technology, maybe that enables you to do that.
Yeah, that's right. Thank you.
Okay. Second, one more question I have, which is, you are investing in this AIF. Now, I wanted to understand your thought about why AIF versus investing directly from the company directly rather than do a AIF. So is it a taxation issue, or what is it that you're trying to do? Why you're creating an AIF versus investing from Intellect directly into the ecosystem companies?
Basically, consolidation becomes a major issue when we have to publish the quarterly result, annual result. Each time we need to do a consolidation if we have a direct investment in the company. It's a painful process of getting the small companies who doesn't have a proper accounting system to then give us their accounts, and unnecessarily it becomes a regulatory and accounting issue. AIF keeps them away, and we don't have to consolidate. It will not be part of our consolidation issue. That's a simple answer.
That's very helpful. Thank you.
Thanks, Rajiv. Next we have Utkarsh. Please unmute him. Utkarsh, can you ask your question?
Yes. Am I audible?
Yeah, Utkarsh.
Sorry for asking again, but can you please elaborate a little more on the purpose of the AIF? And number two, if I heard you correctly, did you guide for a 20% top line growth and a 30% bottom line growth for the next 3 years? Thank you.
Yes, Utkarsh. So purpose of AIF, just to explain again, we need to move in next 3 to 5 years in an ecosystem player. Salesforce.com, if you observe, what is the full story? It's not a product yet. Otherwise, there are many CRM products in the marketplace. It became an ecosystem player. So the journey is from product to platform to ecosystem. IDC has signed up 30 partners on IDC marketplace. GTB has signed up more than 15 partners on their marketplace. So it's a marketplace game. So what happens is that when you are putting somebody in a marketplace, we have a opportunity to invest. If I am giving a technology to the player, the way InfoEdge has given to, let's say, Zomato, or Salesforce has given to MuleSoft or Encino. Please study that Salesforce and Encino model. Encino is the only lending platform. So if you are looking at Encino valuation and Rajesh Sena, who is iCredit 360, these two platforms are a competing space where Salesforce invested into their platform. So that is a model of it. To answer the second question, 20% top line growth for next 3 years. Yes, we are looking for 20% growth. This is a common message which we are giving from last many calls. And We are looking for PBT growth of 30%. So tax numbers will go up. As of now, it's in the range of 12 to 16% numbers. Next year, when the tax credits are not available, may not be available because we'll be consuming it, the rate will go up 20-22% numbers. So the PBT growth of 30% is available. That's what we are guiding.
Thanks, Utkarsh. Thanks a lot. Arun, we can take one more question.
Just take one more. Who is this? Yeah.
Next, we have Mr. Yash Somani. Yash, you can ask your question. Rohan, please unmute him.
Hi. I had one simple question for your SaaS business. For every 1 rupee of SaaS revenues that we accrue, how many rupees of AMC revenues do we forego, sort of say theoretically? I just want to sort of understand, the transition a little better.
Yes, if I'm doing a deal of license plus AMC, if you take a deal of $1 million with AMC of $200,000 per year AMC, in 10 years time, we will be making 9 years of AMC plus $1 million, 1.8 million, 9 years means $1.8 million plus $1 million, $2.8 million. If I have a subscription revenue of $600,000, $50,000 per month, I'll make in 10 years time $6 million. So that's the benefit of a subscription revenue over the AMC revenue. So it's almost, instead of $2.8 million value realized for the company, it will get $6 million revenue realized for the similar kind of a deal.
Sure, that was very helpful. What I meant is actually, sir, in year one, you would forego some revenues, right? And you accrue a lot of these later on. That's so right. How should we think about it in terms of the transition period, in terms of what license AMC revenues we miss out on in say year one?
Yeah, yes. Whatever the results we are publishing, 22% growth, it has bundled into that. So whatever discounting has happened, it's happened in 20% growth. So if you just plan for 20% growth, that will be happy to have the 20% growth number. It's because of those forego numbers are built into it.
All right. Thank you, sir.
Thanks, Yash. Arun, can we close it? There are a couple of more people.
Okay, we can close it.
Okay. Thank you. Thank you, everybody, for joining us. If still some questions are left, please do write to us or call us. We'll be able to help you. Thank you for joining today.